All right, for those who missed yesterday was part 1 of 2 scanning and planning. We went over looking for uptrending stocks with the 20 and 200 SMAs, talked about the scanners, sector performance, where to find it, where to find upcoming news, insider buys, float size, SEC documents from Nasdaq's page. We went over charting, talked about some SMAs, EMAs, Fibonacci retracements a little in detail. Looked at patterns. Another place you can find patterns to review all of them is stockcharts.com. If you just Google stockcharts.com chart patterns, it'll bring up a whole list of chart patterns. Yeah, if you can't hear, go to the left side menu and scroll down to the class audio channel. That's where we'll be in. Direct people. Yeah, there you go. He posted right there. We talked about targeted gains, where to place a stop, and that's where we left it for the day. Today, over entry holding and exits. All right, this is part 2 of the webinar. Day trade, I short sell, I do options, but mainly swing trade. Just due to swing trading be a little bit more secure. It's a lot easier. It's easy to plan your trade too. You know, in day trading, you're jumping in momentum, riding it. You're trying to get out at the right time. With swing trading, you can plan your entire trade. You can plan your exit. You can plan your risk. And it's a little more calculated of a trade. Today we're going to be talking about entering the trade, averaging up or down at the right time, what to watch for while you're holding, lowering your average, locking in profits, and then exiting the trade. Razor blessed. Somebody, yeah, there we go. Post the link. Click that link and put in that password, and it'll show the live feed. All right, entering the trade. So you found a stock that you like. You want to know, when to enter it. You don't want to enter in too late. You don't want to enter in too early. You're trying to find the right time to enter it. So I do a lot of my swing trade scanning on Sundays and Saturdays. On the weekends, I look at scanners. I look at patterns. This is one we talked about yesterday, VNet, VNET, and it's showing this nice ascending triangle with this 100% retracement as resistance. 100% retracement from the initial drop gap right here down to the low, and as it's starting to build its way back up, that's starting to form this ascending triangle with this baseline 100% being resistance. So now that it's come back down and formed this little spinning top inverse hammer on the downtrend, that is a good point to look at and say, hey, that's a support bounce. Might be a good time to enter. Also notice that the RSI is only 50 RSI. It's also trending above the 20 SMA, and it's also above the 50 SMA. Well, as you can see, at the 78.6 at $7.57, that's where it closed at. That is also the Fibonacci resistance, and that is also the bottom of the cloud. So for tomorrow, as an entry, you would be looking to enter this specific play. You would be looking to enter on this break. So it closed at 750. Closed at 757. You're going to want to watch it break and enter into the cloud, and also break that Fibonacci. That way you can get into the play as it breaks into the cloud and starts to rise. All right, do you wait or do you go in? Well, that's the question. When you get in, if my voice is a little, let me know if my voice is choppy. Can everybody hear me all right? All right, cool. So wait or go in. All right, so are you going to wait for the trade or are you going to go in now? All right, that's all depending on a couple of things. Whether you're at a resistance point or a support line. If you're currently at a support line, so this bounced and it closed for the day, up here. But if this bounced a little down here and closed at the day at support, that's when you're going to want to wait. You're going to want to wait and see if that support holds. So don't just get in, just because it's at support. You're going to want to wait for it to verify and start trending back up. So being that this is at a resistance line, it's at the cloud, it's at the Fibonacci, you're going to want to wait to get in this trade at a break of 757. If If it starts to go back down, well, then you could be looking at it. If whoever has their mic on, please turn that down. All right, if it starts to break down, you could be looking at a 20 SMA test of 749, and then further retesting the 61.8 as well as the support line. And then you get even further supports all the way down. So that's why you don't want to jump in right away. You want to wait for the resistance break. That's when you'll get into the trade. A lot of things are happening right here. All right, you got 78.6 at 757. You got the cloud at 757. You got the 50 SMA at 757. So this is a pretty strong resistance point right here. You're definitely going to want to wait for that to break before you get in the trade. You also have the day's high. All right, so Friday's day high was 765. All right, so 765 is going to be another key point to break across because you're looking for it to break the previous high, to continue going up. That's a resistance point. So if that can break, your next point of resistance is going to be up here at the 100% at 779. So that's going to be your entry. That's also going to be your waiting whether it starts going back down or starts going back up. All right, how would you be able to tell if the break is a head fake or not? I mean, that's based off of volume coming in. You're gonna have to watch the level 2. Just because it breaks above 757, that's where having the level 2 pulled up is going to help you over here. So if you see a 757 break, but then you see at like 760, there's 500 on the ask. That's it's probably going to be a good wall. You might want to wait for that to disappear. You don't want to just jump in a trade with 500 on the ask. All right, averaging up and averaging down. Before we talk about that, I'll show you as well for people who didn't turn in yesterday. So based off how the stock is trending, this is VNET, VNET. You can go to Finviz and check on that stock itself by typing it in. And then right here, it'll tell you it's in the Technology, Information Technology Services. All right, so when you go to your heat map, it depends on how long you're swinging it. If you're swinging it for a week, you can do a week performance, month performance, however long you intend to hold. Usually, I'm doing a 1 to 2 week hold, so it's going to be I'm going to be using the month to get a good estimation of how it's been during that month. I also want to use the day so I can see how that sector is doing that day. If that whole entire sector is just blood red, I mean all these are blood red, then I'm probably not going to enter that trade that day. Or at least I'm going to wait and see if it goes down for a better entry. But being that this is in the technology, I believe it said information. Yep, Information Technology Services. So you can find it on here, technology, and then you look for Information and Technology Services, which is right here, information technology. So that overall subcategory of that sector is doing pretty well. You got a couple big green ones, a couple neutral ones, only a few red. So information technology is pretty good right now. I would call that a pretty good entry as far as that, performance over the last month. Now you would want to look at it on the day as well. Now being that this is Sunday, is Finviz a paid service? Finviz is not a paid service. What I'm showing you right now is free. But you can also get Finviz Elite, which comes with a lot more features. You can look at Finviz Elite, everything they give you on their website. 1 day performance, the information technology, not doing too good on Friday itself, which is why you would want to have this up come Monday. Come Monday, you can hit on here, see how technology is doing in general. You can also see how the subcategory is doing as well. And then that's basically how you're planning your trade to get in. That's also how you can look to see if, whether you're going to jump into that stock right away or not. All right, as far as averaging up or down, when to do it. So let's say you've gotten to the stock, right? You got into here on the break. It's at 760 confirmed. There's no huge asks. There's not really a big wall to take you. Well, as far as moving averages go, your next one is at the 100 SMA way up here. So your next point of resistance is going to be the 100% retrace at 779. All right, so are you going to look to average up, or are you going to look to average down? All right, that all depends on the flow of the stock. So when you come back to your intraday time frame, here we are sitting at the 757. If this were to break and come back down and test the 757, that could be another point where you could average to your trade. You're not necessarily averaging down, but you're getting more shares on a support bounce. Now, if that were to break and come back down to the 61.8 at $7.40, it's already tested before and rebounded. So that could be another place where you could average down, buying more shares, basically lowering your average. If you bought in at 757,000 shares and then you bought at 740,000 shares, take the difference, and your new average would be somewhere in the middle. So that's how you would average down on a support bounce. Now, averaging down can be tricky, because if it comes down and you average down, now you're averaging down at support, which is where you want to be if you're averaging down. But you also want to make sure it doesn't continue to go down. So here's your trend line, and then here's your next point of Fibonacci retracement. All right, that would be where you would look to, cut a loss or average down further, depending on how the stock itself is doing. But you don't ever want to average down if it's starting to break points of resistance. You're going to want to average down if this tests and start to come back up. So how this did right here, how it came down to the 61.8, tested it, and then came back up, I would look to average down on a 13 EMA break about. So it breaks right above it. 13 EMA is this blue line here. So when it breaks up, now I'm at 744, 745. That's where I'm going to be looking to average down if my entry was at 757. And then vice versa, if it was up here, come down to here. You always want to make sure you're averaging down on a confirmed bounce. Confirmed bounce is getting back over that intraday resistance, which is your VWAPs and your 13 EMAs, as well as your Fibonacci retracements. And then you also have your intraday patterns as well. So on here, you could also have some little intraday ascending triangle going on. Bounce on the 100, came back down. You could be averaging down here, come back up. You could average down here, come back up. You could average down on the support test, and that's where you're going to want to go. As far as averaging up, so if it looks like you're going to average up, you don't want to average up on something that is getting to a resistance point. You want to average up on resistance breaks. So if this comes up and it breaks the 100% at 779, and now you're starting to see 783, 784, that's where you could potentially add to your position, assuming that there's no huge walls on the ask. And basically you're adding more shares. Yes, your average is going to go up. So you're going to have a higher average based on the share count you have, but you're also adding more shares in an upward trend. So adding at the 783, 84, 85, that's going to take you, as long as everything is moving good, as long as no big walls come into play, no news comes out with the stock, that's going to take you up to the 127.2 retrace at 807 with more shares in the game now, and now you're making more money because you've added more to your position. You could also set a trailing stop. So let's say you average up at 100% break and you lock in a trailing stop. So a trailing stop versus a normal stop. With a normal stop, and it depends on what broker you have. Somebody mentioned Robinhood. With Robinhood, you cannot do a trailing stop. You can just do normal stops. But with a more popular broker, E-Trade, Interactive Broker, TD Ameritrade, they all have trailing stops. With trailing stops, I tend to use a cash amount over percentage, just because it's easier to do the numbers in my head as far as setting the stop. So if this were to break and continue up, I could add to my position as well as set a trailing stop, and then I could wait till I hit a profit target margin, somewhere around these key resistance points, if they don't break or not. All right, what to watch for while you are holding the stock. So if you're in a uptrending stock, which you should be, because you do not want to enter a downtrending stock. That is bad for your money. But let's say you're in a uptrending stock and it's starting to break. Breaks above the resistance, it's coming up. what to look for. So you're looking for a couple things. You're looking for, you definitely want to be involved in the company's news. All right, having good news platform is a good way to stay involved with the company. Another thing you can do is go to the company's website. So if you go to VNet's website, you can sign up for their newsletter, and they'll actually give you the latest 8Ks, any type of press release. They'll normally give that to you before it gets sent out on news stream channels. They don't always, but normally if you're subscribed to their newsletter, you'll usually get stuff a little earlier than the rest of the world. Another good place to get your news is just your broker. If you have a good up-to-date broker, TD Ameritrade's a good one. Their news usually comes out pretty on point. That's when you get your news as well. And you always want to be paying attention to the news that comes out, because that's gonna dictate the direction of the trend. As far as watching the bid and the ask, so you're gonna want to watch the size. If you're in the trade and you're in this upward trending trade, it's already broke key points of resistance. It's coming up to another. These are resistance points, so you will see bigger asks coming into these key points. All right, if you're coming up to here and you're starting to see 500 on the ask and only 100 on the bid, that's going to tell you that there's a lot more people looking to sell at this point than there is looking to buy. Right, and that could potentially scare people off that are in the trade, and they're going to want to look to sell. And once they start selling, the price is going to start coming down. One thing you do want to look for is higher bids. All right, so if you're seeing a higher bid number, like let's say this is 500 and this is 100, the ask is 100, the bid is 500. That's showing you a good support. So if you have a good support on the bid, that means a lot of people are looking to buy at this price, and it's going to break that resistance usually. Does anybody have any questions on entering the trade, averaging up or down, what to watch for while you're holding before we continue on? All right, scaling out. We'll talk about scaling out. It's exiting the trade. We'll talk about that in a minute. Does anybody have any questions on the topics we already covered? Cool. Yeah, if you're in voice, feel free to talk in there, or you can type it in. Can you explain the level 2 bid and ask? Sure. So bid and ask, you'll have your market price. On any broker that you're using, you're going to have the market price, which is this right here. Market price is nothing more than the last price that the stock traded at. So if somebody bought the ask for $8, you're going to see $8 up here. If somebody got their order filled because a seller sold to the bid at 722, you're going to see 722 up here. All this refers to is the last price traded. Now your bid is basically what people are willing to pay, and your ask is what people are willing to sell for. So if you're looking to get in this trade, you have one or two options. You could put a order up and try to beat this guy. So you could put this is a huge spread. We're in after hour. We're not even in any hours right now. So this is a weekend. This is nothing. But during live trading, this will be a lot tighter. At 757, you're going to see probably the ask at 757 and the bid at 756. But you would have two options. You would place an order at the bid for 756, or you could buy the ask, and that's what people refer to as slapping the ask. So when you hear somebody say slap the ask, that is them basically doing a market buy. So when you hit market buy, it is processing on the ask, and you're getting into the trade immediately at the available price. Now, if you want to get your own price filled, you could set a limit order, and that's where you would be able to get in at the price you specify. So your order won't fill unless it fills at the price you specify. So if the stock is at 757, but you want 750, you can set your limit order at 750, and that's the price you're going to get, or you may not get it if it continues to go up. Does that answer your question about the bid and ask? All right, cool. All right, lowering average and locking in profit. These are one and the same, and basically you could do one or the other, whether you want to do a break-even level or you want to take more risk on your trade. All right, so let's say that this is trending up and I want to lock in profit. Okay, on a trade, for example, let's say you're in stock XYZ, all right, and you bought 1,000 shares at $2.50. You now have $2,500 in the game. Also factoring in commission, you know, your 10, 20, 5, 7, whatever you're paying. But as far as share value, you have $2,500 in the game. And the stock starts to move up. All right, so it's trending up. Now you have two options you could do. You can lock in profit, or you can lower your average, and they're done by the same way. All right, so if I sell 500 shares at $3 after being in at $2.50, that equates to $1,500. That leaves me with 500 shares at $2.50 for a value of $1,250. All right, the 1,500 plus the $1,250 is $2,750. My initial entry was $2,500. That leaves me with a $250 profit if I get out on my remaining balance at my entry of $250. I have a $250 profit if I get out my 500 shares at $250. So if I get out at a resistance point and it continues to go up, I set a trailing stop, and it allows it to keep going up and keep locking in profit. And then when it crashes back down at some point, because I mean it's going to crash back down, it's going to consolidate. The stock doesn't move up forever. So at some point it's going to hit some wall and it's going to start coming back down. It'll either hit your stop or it'll hit your trailing stop, depending on where you set it at. And you can use a normal stop as a trailing stop. You just have to adjust it. But that's your two options. You could have it hit a stop or a trailing stop. As far as calculating whether you're going to have a profit lock or a break even, that leaves me with $250 profit if I get out my remaining shares at 500 at $250. But what this also does is selling 500 at 3 for $1,500. That gives me 500 shares at a $2 break even. So I've essentially lowered my average from $2.50 to $2 by selling 500 at 3. Does that make sense to everybody? I made a new break even point, so I've reassessed my average, or I've locked in profit if I get out at the entry point. So that's two ways you can look at your trade, whether you want to assess your trade and put in a new risk. Now you have a $2 risk, which is a break even. That it could crash 50 cents under your entry and you'll break even. Or it could come back down to your initial entry and you'll have a $250 profit, which is 10% of your initial entry. So there's your 10% gain, where we talked about the 10-10-10 rule. 10-10-10 being I go 10% max of my balance of my portfolio. So say you had $10,000 portfolio, you would go a maximum of $1,000 into a trade. That's 10%. Of that $1,000 comes the next 10, which is 10% risk. So you're only going to risk $100 of that $1,000. So risking $100 of the 1,000 of your initial 10,000 is 1% portfolio risk. And then the last 10 for the 10-10-10 rule would be targeting a 10% profit. So selling 500 at $3 with an initial $2.50 entry gives you your 10%. And then you could set a trailing stop and continue to ride the momentum up, as high as it'll take you. And when it crashes back down and you get stopped out, well, now you've locked in that initial 250 plus whatever those extra 500 shares have carried you to. Do I have any questions on that? Does that need to be clarified anymore? Yeah, so it depends. It depends on your account size. Somebody said they have 3,000 in their account and they do 1,000 per trade, so that's a 33% risk. Now, you can say something like, yeah, I put 33% in and I set a trailing stop, or I set a normal stop. But during the day or after hours, depending on how you're holding that stock, just know in after hours you don't have stop loss. All right, there's stop losses processed on market price, and in after hours and pre-market, there's no market price. So if you're holding something into the night, into the day, and you're putting in 33% of your portfolio, and something comes out with news, companies filing Chapter 11, they're going bankrupt, whatever they're doing, bad FDA product approval, whatever the case may be, and it starts to crash, unless you can get a limit sell in there, there's really nothing else you can do to protect your cash. So, I mean, putting a lot of percent of your portfolio in one trade is not advisable. It also, it depends on the account size too. If you have a couple $100s, a couple $1,000s, you need to play by your means. That's where using Robinhood is helpful for people to use a commission-free broker. But having a good broker that has after hours and pre-market access is definitely beneficial. That's going to save you a lot of headaches. It's going to save you a lot of lost money. Your orders are going to fill when you click them. I can't stress enough how good a good broker is. Does anybody have any questions on lowering your average, locking in profit, or anything else that we've covered? All right, so exiting the trade. We'll talk about that real quick, and then we'll talk about some questions if anybody has any. So exiting the trade. Let's say that you're in your trade and you're looking for an exit point. Well, me personally, I look to target profits, obviously at my 10%. So I'm looking to take a 10% on a trade, depending on my entry. If I get in at 750, I'm looking for a 75% or a 75 cents increase in this price to lock in my 10%. And as it's trending up, you're going to want to watch for key points of exiting. So you don't want to exit too soon. You don't want to exit too late. I mean, too late's not always a bad thing, but you don't want to exit too late in the sense of you've exited your entire position and gotten less profit than you could have. So if you take some profit when you can, so let's say you're up 50 cents, $1, 25 cents, whatever it is on the trade, and you lock in profit by selling a third or half of your shares. Now you've essentially locked in profit to where if it continues to move upward, you can set a trailing stop and lock in further profit. So exiting the trade can be tricky. You want to exit as much as you can at the peak point that you can. So I recommend once you're up 10% of your trade, either getting 50% of your trade reduced, so selling 50% of your shares, or doing a 1/3 reduction. So selling 1/3 when you're up 10%, and then continuing to go up into the trade. So let's say we break this 100% line at 779. There's no real major resistance on the ask. It continues to remain, 2, 3, 4, whatever it is, and the bid is higher. That's showing that there's, momentum coming into the trade. Also, you're looking at your sectors, making sure that it's green on the day. So we're at the day performance. We're green on the day. We look at the company itself. We're watching for news. We're watching for upgrades, downgrades. Also reading your 8Ks, which we talked about yesterday. So get into Nasdaq. Type in, you can Google search VNet SEC documents, and it will pull up all the latest SEC documents for VNet or whatever ticker you're using. You're going to want to look at 8Ks mainly. Those are going to contain all the news that pertains to the stock that you're holding. So getting in there, opening it up, you can see future dates for possible reverse splits. You can look at the company maybe buying shares, insider shares, talking about upcoming news that they intend to release. I mean, sometimes you can look at an 8K and they'll talk about a broad time frame of when they intend to release certain key points of news. In the 8K they'll say, we intend to release this around third quarter, right, in its first quarter. Well, if you're continuing to hold that stock into third quarter, now you can expect some news coming out. If you've done your DD and you've read that, in that 8K, that news is starting to come out. Also, you need to look at 13 forms and 14 forms. Those are going to talk about institutional buys and insider buys. And then you can also check on Finviz itself. And normally it doesn't have it on this specific stock. But down here at the bottom, they'll have insider buys. And it'll tell you basically how much they've bought, how much they've sold. It'll give you a time frame. Sometimes it depends on the stock you're trading. Not all stocks will have it down there on Finviz, but you can always find all the latest up-to-date information at Nasdaq. Normally 9 times out of 10. That's a key point of research is Nasdaq. Finviz is just a third-party company. They pull their information from somewhere. They're not the guys making this information. They're pulling it from somewhere. So getting the source like Nasdaq is a good place to get all your information from. I just like Finviz because it puts it all in one easy-to-read place. All right, so exiting, it continues to ride up, and you're looking to exit your trade. Don't just exit out of the trade if it can go higher. Set a trailing stop. If you've already locked in 10% profit, don't just get out of the trade. Set a trailing stop, maybe a 3% risk or a dollar amount. Specify a dollar amount on your trailing stop and keep riding it up. Watch the ask. As long as the ask is remaining below the bid, essentially that's momentum that should carry you up. And then watching these key points of resistance. So when it comes to the 127.2, it comes to the 141.4. As the price rises, you're going to see RSI getting higher. And as it starts to consolidate back down, RSI will reduce. If it starts to bounce around in this channel, that's when you could also have some further RSI reduction. But if something is just ripping straight up, bouncing off the 13 EMA all the way up, your RSI is going to climb pretty high. And when your RSI climbs, it gets into the overbought territory. That's where if you have it set for 70 and 30, it'll highlight blue. That depends on your settings, but mine is 30, so it'll highlight blue when it breaks below 30. It'll highlight red if it breaks above 70. But depending on how the stock is moving, if it's just ripping straight up, your RSI is going to climb. You're going to want to not get out too soon. If it starts to consolidate back down, again, if you're already up in the trade, look for those support tests. So if it hits this 161 and starts to come back down, your RSI is dropping. That's a good thing. As long as your RSI is consolidating and you're not breaking supports, well, that's opening it up for more buyers to get in on this upward moving stock. So it bounces off of your support line, starts to move back up, and now you can break the next key point of resistance. So going back to a day frame, that's a lot. All right, so going back to your day frame, this is going to show you where you're going to be looking to get out of your trade. So like we talked about earlier, getting in on the confirmation of resistance break. So breaking above that 78.6 and confirming into the cloud. And then also you're breaking the Fibonacci, you're breaking the 50 SMA. You're going to want to ride this trade up to the next key point of resistance, which is your 100% retrace. And then you're going to be looking to sell part of your position when you're up 10% or more to lock in that gain, and as well as set a trailing stop if it continues to move up, or just set a normal stop, which will get you out of the trade. And then if you're setting a normal stop like on Robinhood or another broker that doesn't have trailing, just make sure you're paying attention to your stop. You don't want to set a stop at the 100% break, and it's up here at 790 and your stop is at 779 and you just leave it there, after it's already tested, 843 and it comes back down and stops you out at 779. That would just be crazy. All right, if all you have is a normal stop, you don't have access to a trailing, Just make sure that you're watching it, and as the stock is moving up, you're adjusting your normal stop. So if this breaks out of the cloud, it breaks your 100% retrace, and it breaks your 127.2. Now you're looking at you're looking at your daily cloud break, which is going to be right here at 814. All right, that's going to be a good key point of resistance. If I was in this trade, I would be definitely looking for a 100% break, because that's your ascending triangle break. And I would probably be looking to exit my entire position, or at least my 2/3 of it, because I've already exited 1/3. I'd be looking to release my second third of my trade at this level right here, or at the cloud break. And that's where I would scale out of my my 2/3 position, if you will, and then on a set a trailing stop and continue to let it rise. And as you're setting your trailing stop, then you're just letting it rise. I mean, you're swing trading. You're not day trading momentum. You're not playing the spikes. You're swing trading. So having a targeted exits for portions of your trade is going to get you the max amount of profit as possible. Because if you're just holding 1,000 shares at 757, and it comes up and it breaks 100, it tests 127.2, but it crashes back down to 100. Well, you've lost out on essentially profit that you could have had with selling portion of here, locking in a trailing stop that followed it all the way up to 807. So if you had a 10-cent trailing stop that would have followed it up to 807, your stop would have been 797. And with the crash back to 797, it would have got you out of your trade instead of getting you out, all the way back down at 100 if you just set a normal stop, or if you had your full position still. Does that make sense? Does that make sense to everybody? Is it better to do a trailing cash stop or a percent stop? That all depends on your preference. I mean, there's really no difference in the sense of how they are going to get you out of the trade. It all depends on your preference, whether you want to have a percentage of the trade or whether you want to have a dollar amount of the trade. I use dollar amount just because it's easier to. I can look at resistances, right? So I can see that this is at 100%, this is at 127. So but the difference between 127 and 141 is only 13, 14, 15 cents. So I'm going to want to have probably a 10-cent trailing stop on here, and then you could calculate that percentage if you want and set the percentage. But calculating a 10-cent stop would allow for this to test, crash back down, and lock you into profit before it bounces off support and possibly breaks. So I personally use a dollar amount trailing stop. All right. One question was, are you always using 9-month daily charts when adjusting your stops? No. Like I said, it all depends on whether you want a percentage-based stop or a dollar-based stop. So personally, I use cash amount-based stops. And it doesn't matter if you're on the daily chart or if you're on a 5-minute chart, 30-minute chart, whatever it is. You're looking for key points of resistance, breaks, and then setting your trailing stop that makes sense within this gap. So if I break 779 and the next point of resistance is 807, I'm not going to set a 30 cents trailing stop. That wouldn't make too much sense because it's going to come back up here. If this tests and fails, it's going to come back down. You're going to get stopped out basically right at that support level. You want to lock in as much profit as you can. So if this breaks above, you got 30 cents gap here, essentially, you're going to want to set probably a 10-cent, 15-cent trailing stop that's going to get you somewhere out in the middle if it hits resistance and comes back down. Does that answer your question? Okay, you're just using the resistance as new supports or new points to exit your trade. So if you break 100% and you have confirmation by a few points, a few cents, you break 100%. Well, that 100% now becomes support. So if that comes back down, you're looking to test. You're not looking to break under. You're looking for it to test. That now becomes support. When you have a break of resistance, it becomes support. How do you draw the fib lines? All right, for the fib lines, we covered that a little bit yesterday. We'll run through it real quick again for people that missed it. So for fib lines, it depends on how long you're trying to hold the trade. If you're holding the trade for a couple days, couple weeks, couple months, you're going to want to trace out to bigger gaps. All right, so if I was looking to hold this just for a few weeks, the gap I am looking to fill for 100% retrace on my fib levels, it also depends on where you enter. I mean, entering right here, this is going to give you your 100% at this gap fill. But if I'm only going to hold this for a few days, then I would put my Fibonacci retracement at this initial drop of this gap. If I'm going to hold for more than a few days, let's say a week or two, maybe 3 weeks, this all depends on how long you want to be in the game of that specific ticker, you would set your gap a little higher. So if I was looking to have this trade for a couple days as opposed to a couple weeks, so I was going to hold it for 2 to 3 weeks, I would adjust this to this gap up here. All right, to that initial dropping point where it spiked up and started crashing back down. So this high is 855. So I would adjust to 855. And then all you have to do to set a Fibonacci retracement is go to Fibonacci retracement. You click where you want it. You scroll down toward the bottom of the gap, which would have been that point, and then release the click. And that's going to give you your points of resistance. So a lot of technical traders, they'll chart out resistance lines. They'll chart out a line here. They'll chart out a line, here. They'll chart out a line here. Fibonacci does all that for you. You don't even have to do it. It puts all those resistance points in there. Is the highest and lowest of any given time frame. It depends on the time that you're trying to hold the trade. You can apply Fibonacci retracements to day trades. You can also apply them to swing trades. So if something spiked in one day and it came back down, let's say that you got into, something popped in your scanner and it popped up 50% that day, but it consolidated back down to 10% up for the day. Well, you could take your Fibonacci retracement, apply it at that day's high, and retrace to the day's low, and that's going to give you scaled resistance all the way back to the day's high for a double top break into new territory. Fibonacci will chart all your resistances and your supports with you, because again, when resistance breaks, it becomes support. Somebody asked, so if I get in at 250 and I don't want to sell it lower than 3, if it does move up but I don't want to lose my 250 investment, would I set the limit at 3 and the stop at 250? You're not going to, depends on the broker you have. Normally you're not going to be able to set 2 orders. A lot of brokers don't allow you to set 2 orders at one time. It's going to cancel out your other order. So if you set a limit sell at 3, and then you go and you set a stop at 250, it's going to cancel your limit sell at 3, and your new order is going to be a stop loss at 250. Again, it all depends on the broker that you have. I know TD Ameritrade will normally break your previous order on the same ticker. So if you're trading if you're on the same ticker and you're trying to set 2 orders, it's going to change it to whatever order that was your most recent. So in that case, it wouldn't really be possible. All right, does anybody have any more questions on as far as exiting the trade? As far as limit orders and market orders, we've already kind of talked about the difference between limit orders and market orders, but it all depends on the volatility of the stock. If something is moving very quick, sometimes when stocks get to a key point of resistance and they break, they can start breaking fast, and they can start shooting up fast. I'm sure everybody's seen it where it's broke a key point of resistance, and then it just starts ripping. All right, if you want to get out quick, a market sell is going to be your best option if you don't have hotkeys set up. So with TD Ameritrade, you can set up hotkeys to sell, predetermined amount of shares. I default to 1,000, and you can set it up to whatever you want, basically. And other brokers will also have hotkeys. It depends on the broker you have. You're going to have to look into it. TD Ameritrade has hotkeys. Interactive Broker has hotkeys. Many brokers have the ability to have hotkeys. You can set that up in settings. Where's it at? But if you go to your settings, it'll set it up to where you can have your hotkeys, and you can hit like Shift A, and it'll sell to the ask. You can hit Shift B, and it'll sell to the bid. It depends on how you set it up. But market orders, you want to use a market order if something is very volatile and it's moving very quick. If something is moving kind of slow and it's grinding up slow, that's when you're going to want to set a limit sell, because chances are you're going to get your order filled. It's not going to skip your order by 50 cents like on something with a 1 million share float. A 1 million share float, you're going to see fluctuations of 10, 15, 20 cents. But on something like, a bigger float stock like VNet, which we're sitting at, shares float, you got 78 million. All right, that's a lot of shares, in the sense of things. That's 78 million shares that are available for trading. And this is at a $7.50 stock. So there's nobody going to be buying, 10, 20% of this at one time. You're not going to have to worry about huge fluctuations in price unless something comes out with news and it just tanks. Does anybody else have any questions? If you want to hold a stock for 2 to 3 days, I should set the fib for the high-low of the last 2 to 3 days. What time frame should I use on the chart? Again, it depends how long you want to hold. So in your case, if you're holding for 2 to 3 days, normally we would look for a gap fill of like a week or two. All right, that's going to give you key points of resistance for a couple days hold. Or you could just use the day's gap. So if I was getting into VNet and I was only looking to hold for, let's say 1 to 3 days, I wouldn't be doing on this, month-day chart. I would come down to a closer time frame chart, and I would set my Fibonacci from the initial break point of this high up here at 785. That would be my 100%, and I would retrace down to the low down here at 736. So to do that, apply my Fibonacci, and there you go. So we'll get rid of the other one real quick. And now I have retracements for a couple days hold. So this will give you retracements if you're just trying to hold for a few days. Past that, that's when you're going to want to apply it to a wider time frame. So now you have resistances that's going to apply for just the length of time you're holding. When I get into a swing trade, I like to apply both. So I like to apply it to a longer period of time, like 2 to 3 weeks of historical price. So that's where I would look on my month chart and apply it to that initial gap. Now I would also look to apply it to the shorter time frame, how I just showed you. So I would apply it to, the gap up here or the gap right here, depending on where I got in. And then I would also look to apply it on that previous breakdown. So that previous big giant flush right there where it went, from 784-ish to 734. That's where I would look to apply another point of Fibonacci retracement. That's going to give me intraday resistance as well as multi-day resistance. Does that make sense? The difference between intraday resistance and multi-day resistance. So here's your multi-day resistance, or here's your intraday resistance. That's going to give you resistance key points for, just a couple days of time to hold. And then if you apply it to a larger scale, That's going to give you further resistance and support, new support levels if they break for a longer time period of when you're holding. And Fibonacci is very accurate. If we apply this correctly, so if I get the exact high, which is 785, that's 785, and I get the exact low of 735, which we're at. And if I look at this, right, I have a breakdown, which it consolidated on the 50%. All right, and Fibonacci retracements, 50% is a good key point, and that's normally where you're going to see a lot of support and resistance because it's 50% of the retrace. All right, you using Fibonacci, you're not the only technical trader out there that's using Fibonacci. There's millions of people using this, and they're looking at the same thing you are. So when they see that it comes down to 50, a lot of people are looking for the 50 and see how it just kind of settles on the 50. Well, once it breaks, it came all the way down, you got your new low point, and now it's starting to come back up. And then it hits the 38.2, bounces down to 23.6, and you can see all these lines of where the price is kind of hanging out or getting stopped at. I mean, look at this. This bounced down to the low of that 5 minute. The low is 747. What else is 747? 23.6% retrace. That's 747. So this dipped exactly at the Fibonacci 23.6. And you're just getting this by setting high to low, and it calculates the rest. Does somebody have a question on voice? I thought I heard somebody talking. All right, yeah, no problem. As far as what percentages to set your Fibonacci to, all right, if you look at mine, and also different brokers will have a different way that it sets up, but here's how you should set it up. And I say here's how you should because these are proper Fibonacci ratios. All right, Fibonacci was a guy. He made Fibonacci sequence to apply to patterns in nature. I mean, this was done like a long, long time ago. It has nothing. Fibonacci retracements have nothing to do with stocks. All right, all these numbers, these are all part of the initial Fibonacci sequence when he made it, and he applied it to predict nature patterns. You can, if you take the measurement from your shoulder to your fingertips and divide it from the measurement from your shoulder to your elbow, it's going to give you somewhere around 61 or 61.8. I know you think I'm crazy, but go ahead and do it. Measure your shoulder to your fingertip, divide it by shoulder to elbow. It's going to give you 618, or within, hundredths of it. So Fibonacci applies to everything. And being that many people use it, that's why it makes it accurate in stock trading. It doesn't necessarily have anything to do with stock trading, but it has, everything to do with stock trading in the sense that if enough people use it, it becomes valid. And here are the key points to use when you're setting up your Fibonacci. Setting stuff above 1, so you got your 100%, and if you add more above 1, that's going to give you extensions. So you'll never have to use the Fibonacci extension tool. You'll just use your retrace, and you automatically get extensions if you add them to your retrace. Where do I get a chart that has Fibonacci retracement? That depends on the broker and the charting platform you're using. TradingView has Fibonacci retracements. Most popular brokers have them as well. TD Ameritrade, which is what I'm on now, has it. There's all kinds of them out there that have it. TD Ameritrade is free with zero money down to open up an account. In their policy, it does state that if you don't use the account and you don't fund it, that they can eventually close it out. So just know that if you open one up, you're going to want to put a little bit of money in there just to keep it active. But yeah, they're free to open up, and that would be how you would add your Fibonacci. And what if there is a giant wick? Do you use that in your fib? Are you talking about for the initial low point? Yes, so for the initial low point, if this was your high and you crash down in the gap and you have a low point, That's going to be your zero mark. You want your zero mark on the low point of the gap. And I mean, you don't have to look at what I'm looking at right now. You can go back to a day frame, and you can apply this Fibonacci, you know, a lot easier simply by applying it to the day's high and low. So you apply it from the high to the low, and if you pull it up on an intraday chart, it's going to look just how it looked when we were just looking at it. But always do it from the high to the low. If you are shorting a stock, you can use Fibonacci for shorting as well. So if you're shorting the stock, all you would do is reverse these key points. So 785 becomes the low, and 735 becomes the high. So it will adjust, and now you get your extensions down. So now you're looking to short the stock. So if you bring this into a 5-minute frame, now you're looking at support and resistances on the short side. So if you're shorting the stock, now you have a resistance test. That's where if it breaks above, you would be looking to average down in your trade, and then it hits a resistance and starts to break down further. So you're breaking supports. Now you have resistance points all the way down for your short sale if you're shorting the stock. So you can apply this to the long side. You can apply it to the short side. Fibonacci works both ways. And as you can see, I mean, it's still pretty, it's accurate. You know, you got your low of, what was it, 735? Yep, 735, 735. You got your high of 785, and then your key points all the way down. And then if you add the extensions onto your retrace, you don't have to do an extension. So that's what the extension tool is for, Fibonacci extension. All that does is it gives you these follow-ons. But again, if you add them to your retrace, then you don't ever have to use the extension tool. All right. That about wraps it up. If you have any more questions, you can DM me or one of the other mods, admins, anybody else. So we covered entering the trade. You know, always make sure that you're entering the trade on a good day of that sector, you know, that industry. Don't enter into a downtrending stock. You know, don't enter into a trade when it's testing resistance. You always want to make sure that you're entering into a trade at, if it's at resistance, wait for the break. If it's at support, wait for the bounce. Don't ever enter into a trade when the stock is testing something, because you could enter in and immediately it fails, and you know, now you're stuck with a bag essentially. If you don't have, you know, you're going to have a stop, but if it breaks, now you're getting stopped out and you're taking a loss when you could have just waited and got in on a confirmation of a support bounce or a resistance break. All right, averaging up or down, when to do it. Again, averaging up if it's in an upward trending, or averaging down when it bounces off. You know, I have that confirmed bounce again on support. What to watch for while you're holding. You know, watching for resistance and supports. So watching for resistant breaks becoming new support. Lowering your average. That's where we talked about, you know, buying 1,000 shares at a price, selling some when you're up, taking your 10%, and that's giving you locked in profit if you get out at your entry, or it essentially lowers your new it gives you a new average at 500 shares at $2. And then exiting the trade. Again, you're going to want to exit the trade with as much profit as you can. So if it starts to rip up on a resistance break, you know, get your market sell out there. If it's slowly grinding up, get your limit sell in place, and have your limit sell at resistance points. All right. So if you're on the front side of this trade and it's coming up, you're going to want to set your resistance limit buy or limit sells. So on a resistance, if you're calculating 10%, there would be, you know, you'd have your limit sell at whatever 10% is, but you would have it at resistance. All right. Looking at the upside on this is supports. Downward is resistance, because we flipped Fibonacci for a short sale. But that's where you would look to put it. You'd put your limit sells on resistance if you're calculated into a % gain of profit. All right, that wraps it up.